We're proud to have this episode sponsored by ShakePay, the easiest way for Canadians to buy and earn Bitcoin. I love using ShakePay because it's fast, it's easy, the app is great, and it doesn't hurt that they give away free sats, which is free Bitcoin, every day just for shaking your phone. They also have the ShakePay prepaid Visa card issued by People's Trust that earns you up to 2% cash back in Bitcoin. Not points you have to redeem, just Bitcoin added to your account automatically. Like I said, ShakePay really is the easiest way for Canadians to buy and earn Bitcoin. So join the over 1 million Canadians already on ShakePay. Sign up is fast and free. It's so easy, a boomer can do it. Plus, sign up for ShakePay with the promo code Loonie Hour, and you'll receive $10 after you buy your first $100 worth of Bitcoin. That's promo code Loonie Hour. Thank you, ShakePay. Now back to the show. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 62. As always, joined by the three amigos. We got Keith Dicker of Ice Cap Asset Management in his brand new Patagucci vest, and Rich Diaz, fresh off a hot new date of Acorn Macro Consulting. Welcome back to the show, gentlemen. Richard, what's going on, buddy? You almost missed the show. New date.
Oh my God. It was not a date. You're going to get me into a lot of trouble. Thank you, Steve. Appreciate that. No, what's going on is it snowed 4 inches in London. And of course, and in the UK, and that was basically a complete and unmitigated national disaster, combined with everyone really excited for a little bit of snow. So it's very funny being Canadian, growing up in Montreal, where you're used to 30, 40 inches of snow, who knows how much snow. Here, everything shuts down. The trains are down, the schools are down, the buses are down. They don't clear the snow, and it's really quite shambles. But other than that, nothing going on. The World Cup's winding down, and that's it. No dates to speak of. Thank you, Steve. But
hold on, did you take your date for lunch?
No, that was not at all what happened.
Was it lunch or dinner? Because if it's
Let's
lunch,
move on.
that's how you end up in the friend zone.
Let's move on.
Keith.
Well, actually, I'm curious as well. What do you do on a date, Rich? Like, what?
Oh my God, this is so embarrassing. That's not what happened. Let's focus on the snow in the World Cup, boys.
She's probably listening to this show too. We're going international.
Well, I'd be surprised if anyone's listening to this show. But like, so did you go like for a walk in the park, or did you?
No, that's not what happened. It wasn't a date.
Keith really showing his age here. Just taking Miss Ice Cap for a stroll.
Yeah. Okay, yeah, guys. So I'm excited. We're almost at year end. Today's Thursday, December the 15th, which is
10 days.
It's actually, I know this is one of the in my monetary world I like to live in. It's an outstanding day. We had the ECB, the Bank of England. The Fed was out yesterday. The Bank of Canada guy was talking, and my God, if you're not excited now, or actually, I think what's happening, people have become fatigued with 23, and everyone's now looking forward to next year. But we got a couple of weeks left for markets to see how we end up. And as Rich was commenting earlier, so again, today is Thursday, guys. I don't mean that trying to be funny, but man, markets are just getting mullered here today. They're getting whacked around pretty good, except for the dollar, which I think will tie into the theme. Yeah, absolutely. Yeah, the bonds are duration is pretty good there right now. It's up a little bit, but yeah, guys, this is good. Let's hop into it.
Yeah, lots to chat about this week. As we head into the year end here, everyone's sort of checking their portfolio statements and looking forward to the year ahead and of what's to come. And so people have asked about our show here. As far as I'm aware, I'm not taking any breaks. So next week we'll have another show that gets released as on schedule. We'll keep banging them out here over the holiday season. So, stay tuned for that. And I think we're gonna actually try. I haven't even discussed this with you guys, but I think we're gonna try to do like some sort of Q&A over the holiday season, just to try to bring the Loonie Hour community together. So that stay tuned for that. We'll announce some details. So if you want to sort of jump on with us, chat about markets, etc., you'll have that opportunity to do so. But yeah, huge week this week. We had Canadian national housing figures released today. You had US CPI a few days ago. You had the Fed out, the ECB, the Bank of England. So all the big dogs out, basically getting in their final statements of the year. So we'll kind of keep you guys updated on that. But let's open it up here with as usual, the Canadian housing side. The national housing figures came out this morning. So the home sales fell 39% on a year-over-year basis in the month of November. So again, if you're a mortgage broker or realtor or whatever, basically a 40% cut in your sales volume. And then, prices continuing to decline. This is really the story that remains to be told, really is ongoing, which is national house prices fell another 1.4% in the month of November. Prices are now down. So if they peaked in March, so prices are now down 16.4% since peaking. So that's the steepest decline from a peak to trough perspective since that national home price index was created in 2005. Now, again, keep in mind, guys, I'm not talking about the average sale price or the median sale price, right? Like if you have an average sales price that can be volatile, like if the composition of housing changes, i.e., less luxury houses are selling and more one-bedroom condos are selling, of course, your average price will decline. This is a home price index, which strips out sort of that volatility. It adjusts for the composition of sales of homes that are selling. So what that's telling me is like the fact that you have a 16% decline from peak to trough, that prices are still declining by more than 1% a month is pretty significant. Now, the one thing that if you parse through this data, it's not all doom and gloom, it's kind of the story that we've been talking about for many, many months now, which is sellers are still not flooding the market. So house prices are horrible. Sales are down 40%. Interest rates are way up. Surely it's the time to panic, hit the sell button. Everyone's going to start foreclosing. It was the second.
Did you say Shirley?
Yeah, Shirley. Do you know her? Thanks for interrupting me.
Oh, it was a terrible joke.
Anyways, sellers are not flooding the market. Second weakest month of November for new listings in 17 years. So I believe it was 2019 was the worst month for new listings for whatever reason. I honestly have no idea. But anyways, so this is the story. If you look at months of inventory on a national basis as well, I think it's around in the low 4.4. It's basically back to pretty much what it was pre-pandemic. So think about the national housing market from an inventory level perspective, back to levels last seen during the pre-pandemic. Pre-pandemic was a fairly strong housing market. So we're not oversupplied. We just have extremely weak demand. I still think that there's going to be more listings coming in the traditional spring selling markets. That's going to be the next test. So if you want to figure out the next direction for the housing market, are we bottoming out? Are we getting another leg down? You're not really going to know until the spring market when the inventory comes, and that's going to test the level of demand that's out there. I'm skeptical that the level of demand is going to be able to meet the level of listings that are coming to market, but that's your next test. And like I said, house prices on a national basis down 16%. That certainly matters for the big banks there. Keith, I don't know if you have any comments.
Yeah, what I find interesting, because we've been talking about the variable rate mortgage story for a while, and we're starting to see some of the data coming in. It is definitely having a negative effect on a lot of people, and then we have the anecdotal stories with it. We all know if it's not yourself, it's friends or family, they're being hit with it. But now I'm starting to see stories pop up about people who are now fearful because they have to renew their fixed rate mortgage, which is coming up now in the next 6 months or so. And you're starting to see the same, concern, from these people. So one story I just saw on one of the news lines yesterday, this lady, she said she won't be able to afford home payments by the time the mortgage renewal comes up in March. She said we don't stand a chance, so we're packing right now to sell our house and trade down or whatever they're going to do. And it's really heartbreaking. And I think someone else, I don't know if someone shared with me this yesterday as well, or maybe it's one of you guys, that I think 50% of Canadians are now, what was it? They're concerned about food prices, or they can't afford the groceries, something in that line.
I'm always a little bit skeptical of those surveys, but
Me too.
I think the point is still valid, Keith, which is the financial stress is undoubtedly building.
Yeah, absolutely. And so, I mean, so, this was leading into, you're talking about housing, then the Bank of Canada, of course. And now, the next Bank of Canada meeting is coming in January. And markets right now are pricing in that they're not fully convinced there'll be a rate hike. Whereas now we're getting this tug of war. And by the way, the Bank of Canada now, I have no idea what those guys are going to do. They are flipping and flopping all over the wharf, so it's hard to tell which direction they're going to go. They want to sound hawkish, but markets right now are suggesting they won't be. And but I think now they literally are at that point where if they do much more, it is going to create a lot of pressure on a lot of Canadians. But in reality, that's what they want, because the only way you can crush demand is by crushing people's spirits so that they're losing their jobs and stuff like that. Like we're in a very precarious financial moment right now, and financially we'll see what the Bank of Canada is. And he was speaking this week, wasn't he?
I'm gonna
Rich.
I'm gonna get to that in a sec. Just quickly on the housing front, because we have some comments from. So I think it was one of the deputy governors last week came out and chatted. She had some interesting comments, which I'll touch on. And Rich, you watched Tiff Macklem's most recent press conference. I think it was yesterday. So we'll comment on that in a second. But quick other update as well, just on the housing front. I know there's been a lot of people, especially in the mortgage industry, that have been watching OSFI. So OSFI is the Canadian banking regulator. Every single year, I think on December 15th, they come out and they update sort of their sort of mortgage stress test, basically. And so there was a lot of sort of hopes in the industry that, we've got a 14, 15-year high in interest rates or mortgage rates. What's the point of having this 2% buffer now? They need to lower it. Housing's getting crushed, et cetera, et cetera. So there was discussions about OSFI coming out and altering that. Now they came out today and said, nope, we're leaving it as is. This followed their comments last week, which basically felt that it was they didn't want to speculate on interest rates. And so they basically said, you know what, we're leaving it as is. Now, what was interesting was in the OSFI's release is they said that we will launch a full review of the B20 mortgage underwriting standards in January. And they said, quote, we expect to leave the minimum qualifying rate at its current rate pending the outcome of the review, although the economic environment could result in a more immediate change. The economic environment could. The way I'm interpreting that is we're going to leave it as is. We're going to do this full review, but if the economic environment, takes a crap, we're going to have to make an immediate. It's really like if you're a policymaker, it's the pro cyclicality of your policy decisions, right? So it's like, you typically don't want to tighten lending standards into a downturn. Typically you're sort of you're supposed to be applying the brakes as the market starts to heat up, and you're supposed to be sort of letting off the brakes and applying the accelerator a bit as you head into a downturn. You don't want to exacerbate, a financial crisis, for example. But these guys are not leading indicators, right? The same as the Bank of Canada, you could have hiked rates, 12 months ago. So I'm just looking at that and saying OSFI, I think, probably doesn't want to maybe interfere with the Bank of Canada's job, which is they're clearly trying to curb demand. The last thing I think OSFI probably wants to do is, okay, let's remove the mortgage stress test and make it easier for people to get mortgages and sort of reinflate the housing market.
Yeah, talk about closing the barn doors when the horses are gone, right? I mean, they should have been. I mean, people have been talking about, us included, have been talking about how house prices are inflated relative to incomes and relative to rent in Canada for. I mean, I've been writing about it for 2 years. There's been smarter people who are ahead of that game even before that. So the fact that they're doing this now is just a little bit embarrassing, but I think it's also good. I mean, it's important they're sharing it with us. I think wonder if they have the sort of the stones to like carry through, and maybe, who knows, maybe they shouldn't, maybe they should wait. Because in a sense, I mean, aren't the rate hikes sort of doing some of the work for them?
I mean, if you're going to get let's just say, I mean, there's hardly almost anyone going to get variable mortgages today, but if you're going to get a variable mortgage, I mean, you have to qualify at like almost like 8%.
Wow.
So it's like they're going to give you a loan based on the assumption that you're borrowing at 8 when you're really borrowing at, let's say, like 6. So it's like people's purchasing power is just getting like annihilated, right? So, and that's ultimately feeding through into the housing market, because you're making a bid on a house and you're saying, well, you're asking 1.5 mil, but can't get approved for more than 1.3. And this is like multiplied across the market. And so naturally prices are obviously coming down, as we've highlighted. So yeah, I think the rate hikes and the mortgage stress test, the 2% on top of 14-year highs in rates, is just exacerbating, what people can borrow, and it's exacerbating. I think it's exacerbating the downturn. Now, again, is that what policymakers truly want? I think that's probably what's needed to bring inflation down. But it's that tricky game of like, okay, well, when do you call it quits?
I mean, I don't know. Because I think it'll be interesting. I mean, like, that's why let's maybe what I can address some of the comments from Tiff Macklin then. Like, I think
let's jump into it. So Tiff Macklin, just to summarize here, guys, he was in BC. He didn't call me, actually. It's a little bit disappointing. Must have lost the invite in the mail. But yeah, he was in BC and he gave a speech to, I think, the BC Business Bureau or something. But anyways, Rich, take it away.
Yeah. So, full disclosure, I usually only I try not to listen to the prepared statements. I find it much more enlightening and interesting to listen to the question period and the commentary afterwards. So, Sasumi, you're welcome to read all of this stuff, by the way, just for people who don't know. Every major statement or press release by any major central bank is always either released on the website or on Twitter or whatever it is. So if you're interested, you can read it. But what I find, the reason I like to listen to sort of the post speech presser is they field questions from journalists. Some journalists are better than others. A lot of the time there's like a theme that's like running through all of the questions. And in this case, I mean, and that's what I felt that what was happening yesterday or the day before, or whatever it was. And I think for me, was the theme was, given that inflation is starting to roll over. I mean, it hasn't necessarily happened at the global level, but it's certainly happened in the US, which we'll get to in a few minutes. In Canada, it is as well. The questions that I felt that each of the reporters was harping on was, basically, when are you going to cut rates? When are you going to cry uncle and reverse course on your policy decisions? And the reporters approached that in different ways. One, they talked about the stresses that people were dealing with respect to the housing. Another person cited the yield curve inversion being at like a 30 or 40-year low. Another discussed the fact that indeed inflation was going lower. And I think in each instance, Tiff Macklin parried any kind of suggestion that he was going to cut rates. Now, there's two things you need to know about that. Number one is that they're never going to, put themselves in a corner, and they shouldn't anyway. So it's, in a way, it's a really kind of an expose in being a politician and just saying lots of words without saying anything, which is, I guess, what I'm doing right now too. But also, I think what he really was suggesting was that any rate cuts that might be priced into the futures market, I think, should be discounted. And I think that they're going to hold rates here high for longer than anything anybody expects. And this relates, I think, what's going on in the US, which we'll get to later. But that was sort of my takeaway. Everybody wants to know when they're cutting, and it ain't going to happen.
Keith.
It's kind of interesting. You say, they don't want to paint themselves into a corner, but that's exactly what they go from one corner to the next. Because was it in 2020, they said, hey, we are not going to raise rates till, the year, 2049 or something like that. And now here they are, they say, we're never going to cut rates again. I'm just being a bit dramatic, of course.
Have you seen that video? I was literally woke up this morning scrolling on my phone. And again, whatever, I don't care what your political views, love him, hate him, doesn't matter. But there was a video from Pierre Poilievre, and it was from June of 2020. And he was asking Tiff Macklem, grilling him, saying, what happens to Canadians when interest rates rise by 2%? And Tiff Macklem was like livid. You could so upset, like the look on his face. He's like, that's entirely hypothetical. And of course, if you've been following, we're now up 400 basis points. So 4%, not 2%. So man, what a incredible policy blunder. I know we've chatted about this numerous times, so we don't need to sort of continue to beat the dead horse here, but
it's interesting because yesterday during Powell's presser, somebody gave him a sort of a similar type of scenario, and he responded the same way. He said, we don't deal in hypotheticals. We're just dealing with what they have now. So of course, we have that, but yeah, I know we've said this before, and I just want to reiterate this. And it's not an eye roll or anything. It's just so plain and stupid and easy to understand. The world went through a 40-year period with rates always declining. Everyone always made money on that trade. Then we went for a decade with rates never rising. So the expectations are built in there, and everyone's expectation for the future. And I got a great story to tell you about that from a meeting I had this week. To remind me to chime in on that, because I don't want to forget. But the future is going to look extremely different than the past, and we got to keep reminding everyone of that, because it's going to be incredibly different. So if you continue to think markets are going to behave and central bankers will act like they have in the past, but they're going down this road that they don't know what to do. Actually, it was a great line from the ECB this morning. Do you guys want to talk about the ECB real quick?
Go for it.
You can comment on Christine Lagarde. I know you love her.
Oh yeah. So this morning, ECB guy, he says, QT or quantitative tightening, it's a new experience for us. That was the response. And I'm thinking, oh my God, of course it is. Every single person on that committee, their entire career has been with zero and negative rates and so forth. But he basically said, we don't really know what's going to happen with this outcome. But we'll go more into the ECB in a second. But that's my point. I think so that the Canadians, the Americans, and everyone at the central bank level, like they don't have a crystal ball. They have to sound confident in everything. But whatever they're telling us this week, it's not etched in stone. Because I do think the economy is going to have a pretty dramatic turn coming up in
a general question for you is maybe from the portfolio side, but how do you look at like the whole like passive investing idea, right? Like you just buy the SPY, right? You just buy the S&P 500, you buy the ETF, and you just keep adding cash every month, and you get your 10% a year in perpetuity. How do you view that strategy moving forward in this environment?
Yeah, well, so first of all, it depends on what your age is, how close you are to retirement, and how much money you have in that market. If you're young and you're putting in like $100 a month, and it doesn't matter to you what the market movements are. But we're likely going to see swings in the S&P 500 or any other market. Like we could see annual swings of 30 to 50%, like going up 30, down 20 and something like that. So that is not a strategy we would suggest for anyone, because the older you are, we're always more sensitive to losses than we are to gains. And then the older you are, the closer you are when I don't want to work anymore. I just want to live off my passive income, and that's it. And all of a sudden you're down 30 one year, and then that's just a hard boat to row, as they'd say.
The volatility.
Yeah, it's enormous, right? It's enormous. So the classic portfolio management, objective is to produce higher returns with lower risk, than the broad market. There's lots of ways to do it. I know lots of people are having success with that, but I wouldn't be an all equity guy. I mean, you're living and dying by the sword with that one.
The other thing is that we all have short memories, and I think from what we've seen from the last, I'm looking at it now. If you look at the chart and you can see from 2010 to 2021, December 2021, it was just like a straight line in one direction. And that's happened before in the late 1990s. That happened. To a lesser degree, it happened in the late noughties or whatever in 2000s. But there are times where the equity market in real terms does not do well and is flat for years. So from 1960 to 1980, I'm just doing, the S&P divided by, inflation or CPI, some kind of real return. It was actually negative for large chunks of time. And so it's just, yes, you obviously need to be exposed to equities for, to get some of that growth if you get it, etc., or if bonds aren't going your way. But there are times in history that you just do not make money on equities. And so that's why you do have to be careful. And I think it's about what you described, Steve, is trying to take advantage of beta, which is what people call it, which is maybe a little bit too technical for the podcast, but it's definitely, we're in an alpha world now, which is you need to be much more selective on sectors and companies and currencies and countries, I think.
What's funny though is
just check out
Rich.
Rich, check out the periods 1966 to 82.
Yeah, I'm looking at it right now.
Yeah, and just if you can do the measurement, like the percentage return up and then the drawdown.
Oh yeah, are
you able to do that on your screen?
Sure. Yeah,
and that's a period with rising rates. When the world was a bit of a shit show and everything, and that's what we're going back to.
I agree.
But there's no one around today that was, well, except for some old guys, but no one in the industry today, experienced that before. And I just think it's going to be turning a lot of people upside down.
Just to chime in there, I know you guys are like, I always respect your guys' views on like financial markets. Obviously, I think we have a good depth of sort of insights here, right? We all come from slightly different backgrounds. I find it interesting though when I hear like, guys yourself, Rich, come out and say, hey, you're going to have to be selective. The idea of sort of just like long only, passive, what worked for the last 10, 15, 20 years might not work for the next 10. And so like the one thing I'll say, if you're going to apply this to the Canadian housing market for a lot of our listeners, the one thing that immediately for me comes to mind is in the pre-sale market. So the way that a lot of the real estate investors in Canada have made boatloads of money over the last 10, 15 years is through the pre-sale market. So you put down 10, 15, 20% deposit, and you're basically buying a futures contract. In 3 years, the developer delivers you a product. And during those 3 years, the market just goes up, 10% a year. And, you collect your bag of cash at the door. And today in this environment now, like developers are typically charging 10, 15, 20% above resale prices in order for you to sort of lock in and buy this futures contract. So you're paying a huge premium with the expectation that, well, the market's just going to go up when you're done construction. And I think, well, what if the market's flat to down in 3, 4, 5 years? Maybe we go through a 10-year period of low to no growth. So I think those are the people that have been applying those strategies for 10, 15 years. I think it's going to be interesting.
It sort of reminds me of, so first of all, I'll go back to, I had a meeting this week. So I sit on an investment finance committee for a nonprofit. So it's not related to IceCap. And so we have an advisor that's managing the big pool of money, and it's a lot of money. Like it's significant. And so this is my first time on the committee for when the advisor comes in. He comes in once a year, and I think he's used to, hey, it's a bit of a snoozy group, and he knows more than everyone else. And he shows up this year, or I show up this year, and all of a sudden, I'm listening to him, just sitting there, and he's droning on for 30 minutes, and all of a sudden, any questions? And I said, well, I have a few, of course, right? And I was, and I didn't, I wasn't trying to be one of those gotcha moments or anything, but you have a fiduciary duty all the time. So if anyone's on these kind of committees, you understand that, what I mean. But the interesting, like, one of the questions was, I had a bunch of them. So I just want to hear the answers and the responses. So, for example, one was, we talked about how 2020 and 21, 22 were very volatile years, everything. And I said, well, what changes did you make during that period? And of course, the response is none, because you can never anticipate anything moving. And I'm like, well, that's not really true, but okay, fair enough. And then you start talking about there's a recession coming next year. And I said, well, because there's a lot of money in bank stocks, because I want to talk about that, for Canadians. And I said, you are calling for a recession next year. That's could have an effect on banks' earnings and, stuff like that. I said, will you be making any changes in anticipation of that? And the answer is no. Like, why would you ever sell, your Canadian bank stock? So which then sort of leads me into the whole, then he whipped out an article. An advisor will always keep an article in their binder. They have a whole bunch of them there. So depending on the situation in the meeting, when all of a sudden you need like a third party to confirm something that you don't want to do, you whip this thing out. And this is what the guy was able to do. I know all the tricks. I know what they do. And it was an article from the Globe and Mail, was champion Canadian bank stocks over 30 years or something like that. And the whole conclusion was that you would never, ever sell your bank stocks. That's all you should buy, to which I would say, why don't you have more then, right? You're telling me you can never have enough of these things because there's never any risk. But it goes back to, again, like we just talked about 1966 to 82 in that period. And some you might know of just from reading, but from 69, in the late 60s, early 70s, they had this investment theme called the Nifty 50. Have you guys read about that before?
Yeah.
Is this from Howard Marks's most recent letter?
Maybe.
Continue.
I know he talks about that stuff. Yeah. And so Steve might have seen a movie before in the Nifty 50, maybe. Rich maybe read about it. But it goes back to these, we get these periods, and the same thing in the late 90s with tech stocks, for example. You get these periods where a theme is created and it move along, and then it's believed, by everyone. But back then with that Nifty 50, basically, buying shares of Coca-Cola and IBM and stuff like that. And, you buy good, solid companies that pay dividends. You never have to worry about anything else. But, so from, late 60s to the early 70s, these stocks, some of them were down 50, 70, 80, 90%. And that's my point, like coming back to this misconception of that Canadian bank stocks are unbeatable at all times. Just as, you see, Rich, when you use the football analogy, the Germans lost this time, and well, the English never win, of course, but there's
so mean.
I know. Yeah. It wasn't their fault, right? It was the referee. But Canadians have been lulled to sleep for a very long period with a lot of success from Canadian stocks, specifically in the financial sector. And I'm not saying this to mean, hey, run out and sell them, and because you got to control your risk exposure and things like that. But we've never seen an economy that's been synchronized from coast to coast with a crisis in the housing market. And we're not there yet, but we're close to getting to that point. And if we do, then we'll realize very quickly that, this belief that you're safe and sound every night, it's not true. And that's the whole point with financial history. I mean, it's awesome. You got all these great stories with it and analogies, and old guys, can say, well, back when I was young, we did this and that. But again, it's our concern that going forward, we're in this period where, debt has to be rolled over everywhere. We've gone from zero rates now up to 4 or 5%. It's likely everyone's creating a recession, and the leverage behind housing market was just borne by the banks and so forth. I think it's going to be an interesting year in 23. we're excited by it, but I think some people who are not, excited by it, they could get blindsided, which I think this guy will, by the way, the guy that was, when he
Well,
left,
they're lucky
Yeah.
to have you, Keith. I was going to say that there's a different angle, just like for people who are interested in sort of the more fundamental view of that, banks versus everything else. And it's a similar kind of thing what's happening in the US right now with the tech, which is like, for a long time, banks have over-earned. And you over-earn by, how do banks make money? They obviously make money on your outrageous fees that Canadians are charged to do basic things. They over-earn because they're not productive and there's no competition, but they also over-earn because they issue incredible amount of mortgages. And then they do that, they get fees, or they get the net interest margin, or whatever, however you want to do it. And once that starts to pull back, as we know, the mortgage lending is now starting to reverse, and there's a lot less mortgage lending. That means there's less churn, and there's less opportunity to make those ridiculous fees. And so that's what's happened also in the US. So in the US, the tech sector in America has over-earned. We call this saying over-earned because your profit margins are much, much higher than average, or your earnings per share has gone exponential relative to, again, some kind of long-term and sort of normalized business cycle number. And once that starts to come off, when your profit margins have peaked and are starting to roll over, or people have moved away from buying all kinds of gadgets to moving into services, and you start to revert to that mean, you get a correlate, what happens that's happened in many different cycles in many different sectors. You sort of get the underperformance starts to come through. And just to corroborate Keith's point about the banks relative to the rest of the equity market in Canada is at an all-time high. So you've gone from an all-time low in 1986 or 7, and in relative performance terms, and we'll share the chart on YouTube, it's now all the way at an all-time high relative to the rest of the market. And so, I'm not saying that these mean reversions are perfect, but that's definitely something that I know I look at. I'm sure Keith looks at it too, and it doesn't always work out that way.
So just to comment there, Keith, this is from Howard Marks' letter he actually posted a couple days ago. For those of you who aren't familiar with Howard Marks, he's written a couple books. He's a distressed credit manager. Anyways, he's a really smart guy, one of my favorite writers. But he wrote, so when I got into the investment management industry in 1969, there was the thing called, again, the Nifty 50, and the Nifty 50 comprised the stocks of companies that were considered the best and fastest growing, so good that nothing bad could ever happen to them. For these stocks, everyone was sure that there was no price too high. But he says if you bought the Nifty 50 in 1969 when he started, and held them until 1974, so 5 years, you were sitting on losses of more than 90%. And that's a 5-year period. So that's from Howard Marks there. Highly encourage you. His letters are free. I think he puts one out every couple months. But so there you have it. Gone.
I love that expression. Do you know another good one? And I know my friend Zach who listens to the show, Zach Howard, he'll know the answer to this one. So I'll say another expression. You guys tell me if you know what it means. It's a good day on close.
No idea.
No idea. You guys. Okay, let's continue. I don't want to give it away, but
moving on.
Moving on. It's sort of in with. Here's another thing to think about for next year. It ties in with the Bank of Canada and everything. And so this coming year, a lot of labor unions will have their contracts coming up for negotiation, and they will be offered 2%, 3%, 4%, something like that. And they're going to be livid. They're going to be absolutely going through the roof with those kind of insulting offers. And because they're going to say, hey, inflation is 8, 9, 10% and all that. So the probability of not only Canada, but the rest of the world that recognizes unions having labor strikes this coming year, it's going to happen. It's
already happening in the UK. It's happening in the UK.
Yeah.
There's the sorry to interrupt you, but the NHS, which is the National Health Services, the Postal Service, the trains, the tube, we're having like 3 or 4 weeks of all the major unions in the UK are about to go on strike.
Now, to be fair, I've been in London maybe 10 or 12 times over my life. And every single time it seemed like the two guys were on strike for something. So I'm not quite sure
Okay,
if that.
that's not
I think,
wrong.
I think the Brits are, they won't even flinch at that. They're used to it. But anyway, but jokes aside, it's coming. And as little as, like, for example, I know it's this one sign up in one of the universities I walked through this week. And and I get a little miffed when the university professors go on strike. And my sister lives in that world, by the way. So you hear bits and bits about it. But that has a huge impact on kids that are in school and they're being able to graduate and things like that. But anyway, that is coming, and I'm not trying to sound one way or another for any of our listeners that are involved with this coming up. But next year is going to be, I think, the year from hell for everyone negotiating on both sides, because no one's going to be happy with whatever the result is, and we're going to have it's going to affect us anyway.
But Keith,
yeah,
CPI is falling. What the hell are these guys doing?
I know.
No
that's
pay
what
raises.
Management
CPI is falling.
Yeah. Management will use. So if you're in management, you say to me, hey, it's coming down. And I'll say, well, pay me for what I just lost last year. Do you know what I mean?
Right.
Like it's something.
But we talked about this before. The labor market is a lagging indicator, so which is why you have to be dangerous when you're like I'm sure we've mentioned this many times, but just people who haven't, we're just hearing it first time. Labor markets and in general are lagging indicators. So you have it's like and so we're seeing, even though the labor market is strong and we're seeing wage growth come up, we're seeing a lot of the economy, as Steve pointed out, the CPI is starting to roll over. We talked about the ISM diffusion index. That's rolling over. Whether it's money supply, which we'll get into later, there's lots of other indicators that are starting to go negative, and yet wage growth is actually still on the march in the US. It's less so in Canada because of immigration and stuff like that, but it is.
I think that next ties into the Fed conversation.
No, I want Rich. Can you quickly unpack us the U.S. CPI data?
Yeah,
just very briefly. So just because I think it kind of sets up the Fed here, right? Which is like,
sure.
We've been talking about on the show for a while, which is, listen, guys, inflation is coming down. I know it's really upsetting for people to hear that have a very dogmatic view of the world, but like inflation on a rate of change basis is declining. And so, Rich, maybe walk us through those headlines quickly.
Yeah, sure. So inflation in the US is 7.1. It came in, I think, 0.2 less than what was expected by the analyst estimates, or the aggregation of all of the market's estimates. So that's down, so we peaked, in sort of we peaked around 9%, and then we're at 7.1. So that was headline 7.1. Core fell to 6.0. We've talked a lot about shelter. Shelter continues to hold up in the US, although it again sort of slowed. I think I won't go through all of the numbers like we do with Canada. You guys can look it up on your own. But a couple of key points was core X shelter fell to 5.2%. So that's really coming off. Things that stood out for me were that energy was the energy. That was the real reason, in my view, that you've had a significant decline. So if you look at the actual press release, so they do this again, it's available to anyone. It's really easy to sort of find online. I'm trying to dig it up right now. Sorry, I had it a second ago, and you can see that food still went up month on month, and those like commodities fell, and then services went up on month. But really, what the big drag was from energy. And then used cars and trucks. There's a chart that's going online. Everybody loves this. The Manheim and the used cars and trucks are starting to come down significantly. Everybody's quite obsessed with this.
It's down like 14%, isn't it?
Yeah, it's down a lot. But the thing is, I would just suggest to everyone, and we've been talking about this a lot, it's not just about those individual components. It's about the breadth. So things to look at and that are not rolling over yet are things like the trimmed mean CPI, the median CPI from the Cleveland Fed. There's something called the sticky CPI from the Atlanta Federal Reserve. And all these, the reason all these different Federal Reserve branches come up with their own CPI indicators, because they secretly all compete with one another, I'm sure. But really, it's because they're trying to find out the central tendency. What is the sort of, when you take away the volatile items, what is happening to prices? And what we're seeing is, although we're seeing a lot of these volatile items come off significantly, the tendency is still high. And so that's where I would just, and then we're going to get into the Fed and why the Fed might be hawkish still, et cetera, et cetera. But something that
these
go ahead,
nerds
sorry.
just having a field day over there, eh? Creating all their own indexes.
I'm grateful for it, but like, the median CPI is 6.98, so 7%. You could say, well, it stopped rising, but it's still very, very high. Remember, the US targets around 2% or just under 2%. So that's still well above target. And I think it's going to take at least a few years for that number to come down.
And you noted that shelter was still sticky. So that's the thing is like, I mean, anyone you talk to in the real estate industry in the US, I mean, John Burns Consulting is probably one of the best ones out there, is like, they're all noting weakness in the housing market and weakness in rents now as well. So, but that won't show up in this lagging of indicators at the Fed. So
I mean, it's tough, right? Because the shelter is such a large component of the core CPI basket. It's 41.6 in the US. I think it's 39.8 in Canada, whatever it is. It's around 40, let's just say. And yes, it does roll over slowly. If you overlay, house prices on the shelter component, you can see what's coming, but we're still not there yet. And also the other thing is, I would submit to you that if the labor market in the US is really, really strong and people have some wage growth coming through, they can absorb rent increases at a much faster pace than they might have in a different cycle. And so that's why I'm skeptical about people who think, oh, the US housing market's going to collapse 20% year on year, and so that's what's going to happen to the sheltering component. We'll see. Obviously, we'll keep people posted. Stay tuned, but I'm quite skeptical about that. But Keith, how does that relate to the Federal Reserve and Jerome Powell's comments? And
is that what you talked about on your date?
No, it wasn't a date.
Lunch date.
No.
Oh man,
you guys are so mean. I'm never telling you guys anything ever again.
She's looking into Rich's eyes and said, "You had me on the diffusion index."
Oh, this is so embarrassing.
I know it really is, Rich, but it's fun though. It's good. And one thing, so the reason we talk about the inflation data all the time, just sort of reset everything here. Market participants look at that to help guide us towards what we expect our central bank is going to do. That's what we want to figure out. And because of all the inflation data now, whether it's CPI, PPI, or ISM, prices paid, all these great data points, they're all slowing, right? They're all telling us it's very clear that the speed at which prices are increasing is slowing, right? They're still rising, but not as fast as they used to. So the rate of change, right? And I suspect, by the way, like for example, using the CPI data for the Americans, headline, we're at 7 now, 7.3, I think it is.
7.1, yeah.
Yeah, I think we could be down by 5 by February, March. I mean, I think that's how fast it can come down.
Way.
But let me finish though with the train of thought. With the American CPI number that came out last week, it was not only was it less than the previous month, that was expected, but it was less than what estimates were. And so when that happened, markets immediately say, oh, wow, the Fed, they sounded a bit dovish 2 weeks ago. Maybe they're going to either just do a 25 basis point hike, or they'll get, they're going to say, hey, we're done, we're over. So when the CPI number came out, the US dollar, just got taken to the backyard. And it was risk on, it was full on fun if you were invested for risk on markets. And which brings us to the Fed meeting that we had yesterday. And you guys remember that, I think it was last show, the one before, I was a bit disappointed. I say, hey, I don't know what the Fed is doing here. They came out really dovish and it just didn't make sense. If everyone around the world, that I chat with a couple of days afterwards, they all said, oh, apparently one of the PE firms in New York, they actually ran into problems. So that's why he had to sound dovish to give them a couple of days to regroup and everything. So the Fed that came out yesterday, so the Jerome Powell, the notes from the meeting as well as the presser, he did a 180 yesterday. It was completely different than what he was 2 weeks prior. And this is a bit annoying for investment managers because you want consistency from your central bank. Bank of Canada, are you listening? Hello, McFly.
Jeff.
Jeff, can you hear me? Be consistent, dude. But the Fed that came out yesterday was exactly the Fed that we expect to happen. And what that Fed was incredibly hawkish. And so some of the main quotes. But the point is, the CPI data, it just bounced off them, right? It didn't mean anything to them. Instead, because Rich made a really good point, is that the main thing that he talked about was the labor market. So you can't have a weak economy with less demand if your labor market is still incredibly strong. So it can be strong by more people are coming in looking for work, or there's wages are going up because their employers are competing, or they're paying people to stay and stuff like that. But these are some of the quotes that he said. He said the labor market remains very tight. And that's something that, we would say in the podcast, but for Jerome Powell to say that, again, the labor market remains very tight. That's central bank code for saying, we ain't stopping raising rates yet. You think we're getting dovish? That's not happening at all. He also used the words, he said, demand is substantially greater than supply. Again, that's incredibly hawkish. The risks to inflation are elevated to the upside. I mean, holy smokes, this is completely different. So Rich, if you went another date with this lady you're out with early and she's different next week, oh man, you're like Powell, right? That's what you can say to her. He also said, I can't read my notes.
Well, he said a lot of things.
Yeah, he did. We still have a long ways to go. We're not going to have a sustained period of, he said, we're not even close to having a sustained period of below average trend growth yet. So again, we're in this period where the Fed is still going to be hawkish, which brings us to today. And again, the only thing green on my screen right now, besides the 10-year is the dollar index. It's up pretty strong.
Yep.
But yesterday the Fed reset, and it was very significant, which is going to roll into, again, I think we're going to get into this period where inflation data is going to continue to get soft, and we'll continue going back and forth with what is the Fed going to do. But he now reset expectations to really say, don't worry about headline inflation, worry about, wage growth and stuff like that. It was pretty significant what he said.
And Keith, I know you're a big follower as well. We've just had such a busy week here with all these central banks, but the economic fantasy land there in Europe, the ECB was out today as well. So you had a hawkish Fed, you had the ECB out today. I don't know if you want to chime in on the ECB and some of the commentary over there.
Yeah, the ECB is very interesting because remember their rate is about half of where the Americans are right now, and their statement today in the presser, it was probably the most hawkish I've heard any central bank for a long time.
The ECB.
Oh my God, they came out with the guns a-blazing. It wasn't, yeah, we're gonna raise rates into the futures. They basically said, these are my words, but you'll find the same ones. We're gonna keep raising 50 basis points for a long time. Basically, that's what they said. They're not going to stop hiking. They're going to do quantitative tightening as well. That's what they're moving towards. And when they were, so what was really interesting with the ECB presser this morning, as they were talking, and it was quite obvious they were very hawkish with it. So the euro started to increase rapidly. At the same time, the dollar was rising rapidly versus all the other markets. And I'm watching this, and I'm in a chat room with some other friends, and I say, guys, either the whole market's going to turn now and catch up to the euro, or the euro is just going to roll over and catch up to the rest of the market, which is what's happened here right now. But that's what the Europeans did.
I got a quick commentary, actually. Just so this is from ECB President Christine Lagarde. So she says, quote, "Anybody who thinks this is a pivot for the ECB is wrong. We're not pivoting. We're not wavering. We are showing determination and resilience in continuing a journey where we have, if you compare with the Fed, we have more ground to cover. We have longer to go. We are not slowing down. We're in for the long game.
Yeah. Was it Journey or Aerosmith? I get them mixed up sometimes.
Jeez.
Dun,
Tough
dun.
day.
I know.
Get the drum
But
roll.
but that's what they did. So here's something very interesting. So there's a couple things here, observations. One, they're going to hike rates aggressively into an infinity. They're doing quantitative tightening, and their expectation for economic growth next year is that they might get a small recession, like the smallest one that may happen, and that's it. So they're doing everything that's textbook wrong. So they're actually going to create a more severe recession. That's what I would suspect. And then I learned a little tidbit on Twitter, of course. That's where you learn everything these days. So one of the former, what do you call, if you're on the ECB council, what are you called? I don't know. Is it in Canada, you're a governor and stuff like that?
Rich?
Member.
I want to say governor, but I don't know now.
Maybe
It's
they
been a
get
while
like
since, like,
fantasy character names like Peter Pan and stuff like that. Maybe
come on.
that would be that. Maybe that's what they should do.
You're on a roll
Anyway,
today, Keith.
Yeah, I know. I think I'm pretty good. And but one of the guys, he actually shared something that I had no idea. And this is again why I call it the European economic fantasy land. Did you know? So the ECB, they state their inflation forecast 4 times a year, right?
Yeah,
That's what
quarterly
they do.
quarterly review.
Absolutely. They alternate each quarter. So the first and I think it's the first and third quarter, that number comes from the ECB Governing Council. I just remember what it is. The other 2 quarters, it's actually an aggregate from the 19 central banks that make up the Eurozone.
Why is that bad? Sorry. These forecasts are always wrong anyways. And the US, by the way, they're wrong in the US as well, and they're wrong in Canada. All central bankers are terrible at forecasting inflation.
Correct. But at least you have the same group doing it all the time.
So the same group is getting it wrong is better than different groups getting it wrong. Okay.
Well, it's like if you have your hockey team, Steve, and like every second night you got a different team going out, but you're wearing the same jerseys. Again, it just caught me by saying,
yeah, that is a bit weird.
Yeah, it's
So,
a lot weird.
Just for our listeners here, Keith, like people that maybe don't follow every word that a central bank puts out there and isn't going back, 50 or 100 years to figure out how these guys operate. How much of this commentary from the ECB do you put into like sort of moral suasion or forward guidance, which is you have to talk a big game in order to sort of get markets to act the way that you want them to, right? If you come out, like, to Rich's point earlier, right? If the ECB comes out or the Fed comes out or Tiff Macklin, the Bank of Canada, comes out and says, well, listen, guys, the economy is probably going to go into the dumps here. So we might end up cutting in Q2 of 2023. Well, you're setting up the expectations for that. So you kind of have to act tough. So the only reason why I say this is because I know that there's a cohort of our audience that will literally take every single thing that a central banker comes out and says for the gospel. Hey, the Fed says they're going to keep going and then they're going to go to 5%. They're going to hold there for minimum 12 months. Like I think it's Keith. I don't know if you wanted to sort of chime in there.
It's like, in a just say it's a baseball game. You're the manager and your pitcher is starting to struggle. You walk out to the mound and say, hey, how you feeling? Do you need to come out? He's going to say, no, I'm good. I need to stay in the game. Central bankers will always want to stay in the game, right? They're not going to be able to say, yeah, you know what? We think we're doing this now, but we think we're going to create a pretty big crisis next year. You can't do that, right? That it doesn't work that way. But the Europeans, the other thing to think about as well, if you just say say the Europeans this morning, say they cut rates as an example, and the euro, comes down 10, 20%, like something, pretty dramatic. All of a sudden, you're going to start importing inflation back into the region. So if you want to try to conquer inflation now, you need a strong currency. So that's one of the reasons why the Bank of Canada, like they have to stay, a bit on the hawkish side. And that's one way to defeat inflation. But it's again, all these guys, Steve, they're in a really tough spot, especially the Europeans, because they've had no price discovery in the bond market for a really long time. Credit spreads between the 19 member countries is incredibly important, and the Americans don't have to deal with that, and neither do the Canadians and Japanese and so forth. But they're really sitting on a very awkward chair right now.
There's a couple of things I just want to add. There's one is this is what they're doing, I think, is an indictment on the actions of the past 2 years, which is to say they over-egged it. And so in some ways, like they went too hard. There was way too much stimulus, in my view, both from the government side, especially from some of the central bankers' side. And I think although they might feel like in some cases this might not be the best thing to do going into a slowing global economy, they're now overcompensating, I think, in some ways. The second thing I would just say is we've had a situation, and this relates to we're in a inflection point. And part of that inflection point is we've gone from 10 or 12 years of negative real interest rates. And I think I'm hopeful. Now, I'm always an optimist, so forgive me, but I think a lot of these central bankers have had a come to Jesus moment, and they've realized that having perpetually negative interest rates, in real terms, so negative real interest rates, is not the way you should run a developed market economy. And so how do I define real interest rates? So I use the 2-year government bond yield minus core. You can do this for the UK, Canada, the US, Europe. You can do this for, obviously, forget Japan. That's just, that's a whole other animal. But an incredible amount of the world has had their interest rates below core inflation for years and years and years and years. And this is what precipitates housing bubbles in Germany, misallocation of resources into speculative BS tech in the US, housing bubbles in Canada. And I think finally, some of us have been preaching about this, screaming at clouds for many, many years, but finally, I think they realize that that is a terrible way to run central bank policy. And again, historically, real rates have always been positive. We've had the crisis in 2010 and whatever it is, or 2008 and 10. And now I think what we're seeing is the beginning of that shift where real interest rates are going to be positive again. And that's going to hurt.
I got to say, it just reminded me of something. So I mentioned earlier about the investment committee meeting I had earlier the week.
Oh, yeah.
And one of the best questions that was offered to the gentleman was, what risk do you see outside of Canada that could affect our portfolio? And the poor guy, it was literally 5 seconds of silence, and I could see the wheels starting to, for the first time ever, they had to turn, right?
Sweating.
It was, right. And, everyone was sweating. We're like, oh, geez, what's going on here? And finally, the answer, the mouth slowly started to open. And the answer was none.
Oh, come on. Really?
Come on, man.
And so for, this is a Canadian Century podcast, but this is our point. Like we just, we're, sort of describing Europe is in a lot of trouble here. And one of the benefits we have in Canada is that you may not like what the central bank is doing, but they're pretty solid, right? It's they're put together well and all that stuff. But relative to, say, the Europeans or someone else, which is, very awkward and loose, that is a market that could snap in two. Yeah, that sounded good that time. And you didn't hear it?
No. Keep going.
But that's one of the markets that's a risk outside of Canada that could come ashore and hit Canadians. Steve, what do you got there?
Well, what did you say when he said nothing?
So if you're in that scenario you're on the committee, it's not our job to tell him what he should be thinking about, because after the meeting is over, this person will leave, and then we discuss it.
Right?
Did you share him a link to the pod?
I'm sure he knows who I am by now, and maybe he is listening. But that's how a committee work. You get information from whoever the guest is speaking, because they're the expert, and then after they leave, and then as a committee, you discuss what was given to you, and then we offer our own points of view, that that's the way you would.
You roast him
work
once
it.
he leaves the room.
No, no, it's not roasting because you have a fiduciary duty on the assets. By the way, if anyone out there, if they need help with this kind of stuff, like we're available for that. But anyway,
Nice
it's
cap.
just a great
I can
world.
vouch. Just to kind of wrap things up here, Rich, I know you're in the UK there. Quick commentary on the Bank of England.
Oh Jesus, you got me. I think they raised rates. Oh no, I'm not going to bullshit you guys. I don't know what's going on in the Bank of England. I mean,
Still too busy on that date.
No. I've been to me, it's just what I've been paying attention to is the UK housing market, and the same problems that the Canadians are facing is what the UK is facing. And so we talk a lot about the fixed rate mortgages that are going to get ratcheted up. I mean, I have anecdotal evidences of friends who are just like, my mortgage is about to go up £1,000. That's something I'm really thinking about. The wage growth stuff. I mean, the central bank.
That's heavy, man. That's heavy.
It's a lot. It's exactly what's happening with, and then we have also the
locked in though
on
the lows.
Yeah, I locked in it. I'm not going to brag, but I did well. Let's just say that. Sorry, Keith, bail me out here with the Bank of England.
Yeah, so they did a 50, which was what was expected. There was no market movement on the currency after it, so that's one way to tell. But the other great thing about the Brits, there's an old John Grisham novel years ago, and these three judges were in prison because they were doing bad things. They actually acted as the counsel. Any inmates had a legal problem with something, they would go to these guys and they'd talk about it, and they come out, and the decision was always by a vote of 2-1, right? It was never unanimous on anything. So this morning, the Bank of England, they announced 1/3 voted for a 50 basis point hike, which is what they did. 1/3 wanted 75, and 1/3 wanted 0. So they're sort of like, that's how they came to the 50. In the end, they sort of split it up.
Okay, there you go.
If anyone understands British culture and how they work, everything has to come to an agreement with like 1 million people involved, with hours and hours of meetings. That's the way it works. Right, Rich?
Yeah, I guess so. And no one ever says no. That's the other thing.
That's why that girl took you up on that date. Eh?
Oh my
All right.
God.
Good place to good place to wrap it up. We, as always, appreciate the support. All we ask is that you share this episode with at least one friend or family member, and please leave us a kind 5-star review on Apple Podcasts or Spotify. We'd greatly appreciate that. As mentioned, we will continue the podcast throughout the holiday season here. We'll be announcing shortly a Q&A live sort of streaming event here, so people can kind of engage and ask questions and just be a part of the dialogue. So as always, we'll see you next week.